The world in 2022, intensifying political acrimony, the highest inflation in more than 30 years, COVID-19 still raging throughout the planet, and the stock market, it's not exactly predictable either. There wasn't even a 10% correction in 2021, yet market participants expressed the highest level of anxiety in years. What do you do when everywhere you turn, the corporate media is shouting market turmoil and encouraging fear? Where do you turn for honest answers and insights? Right here. CB3 Live. We exist to deliver accurate, sensible, and well-sourced educational insights on the world markets, global health updates, and the U.S. economic data that can and will affect your financial future. At CB3 Financial, we don't just manage your assets, we become one of them. Welcome to this month's CB3 Live. Good evening, everyone. Live from Nashville, it's Thursday, February 10th. I'm Charles Brown, Portfolio Manager with CB3 Financial. We're glad you're with us. It's been 2 years this month that we began this webcast, and if you've been with us the whole time, thank you so much. Tell your friends. We'd like to grow our audience, but we're glad you're here with us. You probably noticed that we have a new theme. I'd like to thank Innova Digital in Chicago for creating that for us. Really appreciate that. Hope you guys enjoyed it. So, correction, dejection. You're feeling a little unsettled about the market? You've come to the right place. And my prescription is going to be lowered expectations. You'll see that as we walk through the program tonight. So if you're new to the program, be sure to subscribe to us on YouTube. Click the little bell so that you get updates. You can follow me on Twitter. Actually, in the first few months, first few weeks of the year, I've been tweeting sometimes more than once a day because there's so much going on. So follow me there, and you can also follow us, of course, on Facebook and LinkedIn. So for the monthly market review, wow, a lot going on, folks, a whole lot going on. I like this graphic. One of our clients sends me graphics from time to time. So it's pretty obvious, you know, this is like Captain Obvious here. We have a 782-ton rock that has collapsed on this mountain highway, and the sign up there is loose gravel. Okay, so we are in a situation here in the markets where we're seeing a correction. We haven't seen anything like this since about 2 years ago when I started broadcasting. So far, this has not been as deep a correction as that was. My prediction here on the air is that it's not going to be, but it always feels that way because of recency bias. We think back to the last time the market did this and we got all concerned. Let's have a realistic check here. These are the returns of the S&P 500 for the last 3 years. 2019, let's call it 30%. 2020, a little more than half that, it's 16.3. 2021 last year, almost 27%. The market can't just keep on going up, folks, because eventually you run out of buyers. And with that, this is tonight's theme, lowered expectations. I am not calling for a market collapse. I am not calling for a bear market, although some people are, and I could be wrong on this, and I may change my tune. But it will not be a secular bear market. It may be a cyclical bear market. We're going to get into these details tonight. Many of you have asked, especially since last month's program, to go through more details on what we might expect since we haven't had this kind of market volatility for a couple years. So what are the market's concerns? And I've got these off to the side as well as on this slide because I'm hoping to address each and every one of these. These are the top 7 concerns that I've gathered over the last month from the media that I read. A mistake by the Federal Reserve. That usually means raising interest rates too quickly or too high. Runaway inflation, a slowing economy, cresting corporate earnings, in other words, not getting any stronger. Valuation reset, in other words, what's the proper PE ratios? What should we be paying for stocks based on their valuation? Higher bond yields, and of course the geopolitical crises, Russia, Ukraine, China, North Korea. I want to strictly say that these are not things that I am overly concerned about. I am aware that people are concerned in the media, and I'm going to do my best. I've got this list over to the side as I move past this slide, to address each and every one of these during tonight's broadcast. So the number of S&P 500 declines of 1% or more, you can see way back in 2008 was certainly the worst. Okay, so we had 5% or more days back then. It's rare to have a single 5-point decline in one day. We had one in 2020, only one of them. All right, we didn't have any last year, but this is normal market behavior. A 1% pullback just is not that big a concern, folks. And they will happen from time to time. So what's the length of bear markets historically? You guys know that I want to give you the data so that when you leave this broadcast tonight, you can go back and see it if you need, or point it to your friends and say, look, here's the hard data. Turn off the TV. Here's the hard data. First of all, we've just been through 2 years ago, the world's shortest bear market, 1.1 months to fully correct. It's kind of astounding, which I commented on at the time. But these corrections, these length of bear markets are pretty short, really. Okay, so if you go down all the way to August 1956, 1957, October 1957, 14.7, almost 15 months, that's a manageable time because bear markets are in general shorter. In fact, historically, definitely shorter than bull markets. Sure, if you go back to 1937, 1942, it took 62 months almost to come back to normal on that, or come back to the previous market high. I do not think we're in any kind of environment even close to that. So how much time did it take for the S&P 500 to recover when we've had a 30% decline or more? So a bear market's down 20%. 30% is pretty serious. We've had as much as in our lifetime, 52% back in 2000 and 2008/9. But here's the red line. You see the red arrow there. That's the length of time it took the last bear market. Again, it was just 1.1 months back in 2020 to recover. And you can see the different time frames here, the different lengths of time. 2000, 2002 took much longer time. But we do not have a financial crisis right now. We have all of those items that I mentioned, and I'm looking at them on my sheet here. None of them is financial instability in the banking system or a ridiculously overvalued stock market. We just don't have that like we had in 2000, 2008. I show you this chart almost on a regular every month basis. And it's because this highlights what's happened in the market for the last 100 years. The red zones are secular bear markets. You'll see there are 3 of them, okay? Unless you've been alive for 100 years, you haven't experienced all of these. They just don't happen that often. And in between that, you'll see these large up moves, and those are secular bull markets. We are in the middle of one of those right now. When I say the middle, these have a tendency to run for 20 years or more. This one started on April 13th, 2010, which puts us about 12 years into this. We easily could have another 8 to 10, even 14, 15 years. All right. But during a secular bull market, you will see cyclical bear markets. I'll get into these definitions a little bit more in a little bit. So in 1987, you can see there on the chart, if you look really carefully where the black X is, that market crash of October 19th, 1987, that happened during a secular bull market. So these things do happen. We're going to see pullbacks even in the proclamation that this is a secular bull market. What about the business cycle? So what's the difference between secular and cyclical? Cyclical is one business cycle. Okay, a secular market is over multiple business cycles. So it would be useful to know the average length of a business cycle in the U.S. And there it is from the 1850s. The average is about 42 months, and we're above that now. And the most recent business bull cycles have been much stronger than the norm. So you're going way back to see this average pulled down essentially to 42 months. But what we're going through in the last, say, 40 years shows longer, stronger business cycles. I'm giving you this data so that when you wake up tomorrow and the market may be down 300 points in the Dow again or more, this is the hard data. Okay? So what people say, I get emails, our Facebook stock was just, down $250 billion. And that's true. It was a really bad day for Facebook. February 3rd, these are the big market downturns for individual stocks. Here's what they don't show you on CNBC or even Bloomberg. These are the biggest gains in value. Now, I'm going to go back to that. Notice that the biggest down day ever was for Meta Platforms, which by any other name is Facebook, on February 3rd. The very next day on February 4th, Amazon had the biggest up move of any company. So these very volatile days, both up and down, are what happens in a cyclical bear market. Because the bears who always think the market is doom and gloom, they've been shorting the market and they think they're going to win this. So the market turns very turbulent. The market makers, who are the ones on the other sides of the trade at the New York Stock Exchange, go on vacation. And if they're not there to make markets and there's nobody there to place a bid, then the offers just keep pounding in until it goes down and down and down and down. And that's just the way markets work. I can give you more detail on that if you have an interest, but that's what happens during these bear markets. And that's why the market goes up slower and goes down faster. That's exactly the reason. So I want to read through every word on this page, and I want you to follow me. So even in positive years for the S&P 500, on average, the index experiences a maximum peak to trough decline of 11%. All right. Even in positive years, this year's maximum drawdown is now 9.8 in the S&P. I am aware that it's greater than that in the NASDAQ, but the S&P 500 is the standard benchmark. So after a correction of 10 to 15%, which is greater than we've had to date this year, the low for the year is back Monday, previous week. The index has experienced an average 1 year gain off the low of 22%. Okay, so that low from a week ago Monday, on average, we're expecting a bounce of about 22%. That doesn't mean it goes straight up. You can go back and test those lows. And when this happens, the market has risen 12 of the 13 one-year periods where this has happened. Guys, that's a really good set of odds in my book. The average stock market gained 1 year after the first Fed hike. So we're going to be talking about the Federal Reserve. We always do, but we got a little longer segment tonight. All right. The average stock market gain has been 11%, with gains the past 8 cycles dating back to 1983. That's just about 40 years. This is the hard data. This is not the histrionics from the news, okay? Another question I only got once this week, the January barometer. Okay, what's the January effect? That means if January is bad, then the rest of the year is bad. Well, there's the January returns, and there's the final 11 months. This is the actual data from FactSet and LPL and S&P 500. Okay, yes, 2008 started bad, ended worse. Okay, I'll take my chances on 40 years of data. Most of the time, the market pulls through the rest of the year. So the January effect is not that accurate. Don't listen to the media that tells you can't escape it. But because traders and investors do listen and they do start making decisions on emotion, we're finding now with sentiment indicators like this Hubert NASDAQ newsletter, which is an interesting publication, that the sentiment right now, sentiment is what's the emotion? What do you think is going to happen? How do you feel about the market? First of all, you should never think about feeling about the market. The sentiment right now is worse than the March 2020 bottom. That was March 23rd, 2020. It was the last bear market. Remember the 1 month bear market we've been talking about? So what does this mean? I actually sent this data out to Mayberry, and I asked Barney Fife to take a look at it, and this is what he did. Now, for those of you that are near my age or around my age, you're going to remember Barney Fife of the Andy Griffith Show. He just always reacted crazy to everything, all right? But you don't have to do that. Barney could never seem to get out of that, all right? But that's because he didn't have enough data back in the 60s to make decisions like we're making right now, okay? So here's what you're going to see in the media. The perma-bears. A perma-bear is somebody that's always bearish. They're going to claim victory and the next depression. And how are they going to do that? They're going to be those that say they are always negative on the market. And when it actually drops, they can accurately say, and this is true, they can accurately say they called the top. And that's because a stopped clock is always right twice as it circles around in a 24-hour period. So if you just keep saying crash, 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 you're going to be right eventually every several years. And you can always say you called the previous ones because you did that too. But then what you have to do is ask that person to produce their track record, because anybody predicting that much negativity is not going to have a great track record. They're either going to be short the market or they're going to be out of the market during these huge moves up. Okay? Number two, this is a cyclical bear market. If indeed we're in that, I'm borderline on this. I'm not convinced yet that it's going to be, but some of the smartest people I know think that this is going to be a 20 to 25% pullback, which is the definition of a cyclical bear market. So study history, ignore CNBC, the sky is falling, all this stuff. A cyclical bear market usually lasts 3 to 6 months. If you're doing that within a secular bull market, I'm going to continue to talk about this on my shows so that you know when we might be able to pull out of this. The main problem we have is sentiment, which is the next slide. But a cyclical bear market tends to last 3 to 6 months, although every once in a while they may last a little bit longer. So what drives this? Well, when sentiment, again, I mentioned that word earlier, the emotion of traders says, oh, it's over. It's over. The market's going to crash. I've got to get out. Go to cash, call your broker and get out. All right. Sentiment has to be reset. Now, what does that mean? Warren Buffett would say the time to buy is when there's blood in the streets and the time to sell is when there's absolute euphoria. All right. We don't have blood in the streets yet. We still have a lot of super bullish people. Some people that are in their 20s and don't know anything but an up market since April 13th, 2010. And those are going to have to, the Reddit group, as I mentioned here. Okay, they don't even know what a bear market looks like. And I'm not talking about a secular, ugly 50% down market, just a correction. They don't even know what a correction looks like. This lesson's painful and it's only going to go worse. But the good news is this past week, a week ago Monday, we hit that dramatic low and then rocketed off that. And now we're trying to find where the base is going to be. And of course, with the inflation data, which I'll come out with later on, that kind of got revealed this week. Even today, the market, was up and then it gapped way down. It went back into the positive and finished the day way down again. Just tons and tons of volatility. That is the hallmark of a cyclical bear market. Okay, you see this chart all the time? And now I'm addressing cresting corporate earnings. Okay, are our corporate earnings cresting? The normal return is 70% of stocks beating their expectations. With 342 stocks in the S&P 500 already having reported, we are at 78%. And technology, which is the most leading of the 11 sectors, 90% beat rate. You won't see this in the media because it goes against their narrative of histrionics. But this is the hard data from Reuters. Okay, from Reuters. It says retentive, but that's their marketing program. This is from Reuters. They've been doing this for 80 years. All right, I'm going to get a sip of water. This is where we are performance-wise. It's been a tough, 3 to 6 months here because our growth strategy has really just, it's been hit. It's been hit hard. We're still beating on a 5-year basis. Capital growth still beating the S&P 500. It's actually tied with the S&P 500. On a 3-year basis. Strategic growth, which is even more aggressive, really getting knocked on the chin. But in my opinion, and this is going to be a Kathy Woods kind of statement, if you don't know who she is, she's one of the most famous hedge fund and ETF runners out there. And she just keeps buying and doubling down. She said, you're going to see a bounce back here, but it's going to make the 2020 bounce back, which you guys were living through with me as we started this broadcast. That's going to make it look tame. All right, so I'm going to pause and get a sip of water and a breath and shoot your questions. Hey, Hossein. Hey, Larry. A little bit lower than you. Okay. Thanks, Doc. Appreciate that volume. If Innova is still on the line, we just need to bump up maybe a 3 dB compression or something on the opener. But anyway, I hope you guys enjoyed that opener. So good to see you, Larry. Glad you're here. All right. So as a reminder, these are the last 3 years of returns. Really, really good. What's this year? This year, we've got to have lowered expectations. It doesn't mean it's negative. Doesn't mean we hide under a rock. It just means, come on. We really can't do 20-something returns, 20-something percent returns year after year after year without taking a pause, without taking a break, especially with all the other things that are going on in the world. Okay? So that's where we are performance-wise. I end that first segment saying, here's how we got to where we are right now. Those of you that are clients, you see your performance. If you want more detail, you can call me or email me. If you're watching and you're just a fan of ours, and that's great, we love that too. Just realize now as we go forward, this is going to be what I see that are the factors that's going to drive the next month in the market, which I'll then report on March 10th. Okay, so the employment scenario, the reason we do this program on the second Thursdays is because the first Friday of the month is when the employment data comes out. I've never shown this slide, but this is actually the unemployment review. I like to call it employment, but this particular company uses the word unemployment, and it just shows you around the world what the unemployment rate is. We're pretty low here. You see Latin America at 10%, North Africa at 13%, even Western Europe at 7.3%. The U.S. is in a pretty good place now. Obviously, Southeastern Asia, Philippines, Taiwan, etc., at 3.2%. But in general, we have a pretty strong employment scenario here in the United States. The survey for the non-farm payroll for last month was 125,000 new jobs. It came in at 467. This was the single biggest beat since the early 1900s or whenever they started keeping this data. I was very encouraged by that. So people continue to find jobs, and this is what it looks like on the chart. You can see the enormous drop that we all experienced when this broadcast began, or this broadcast began when this COVID drop happened. But we're getting really close to being back to equilibrium, what we're calling is 2019 equilibrium. If you look farther, okay, from 1953, 2001, this is what it takes to come back after a typical recession. Look at the velocity and, yes, the V-shaped correction that this move has had in employment. It's just astounding. And what's mostly astounding about it, you can say, well, it's not come back as quick as some of the other ones, but look at the depth of those recessions. Minus 2.5%. We were down 22.5% in GDP. It's just crazy. And the unemployment rate, all right? And the bounce back from that is a testimony to those states with firm leadership that have reopened and gotten back to business despite the fact that this horrible pandemic is indeed killing hundreds of thousands of people. Quick comparison here. The blue line shows how 2020 is doing versus 2008. Bottom of that shows how this great lockdown and recovery, current recovery versus the previous cycle. Both of these data points show that this particular recovery has been unbelievably strong. And it's just going to take a faltering of these blue lines for me to get the least bit negative about our situation here in America. We have made an enormous comeback in a short amount of time due to the strength of our economy, irrespective of who's in the White House. We have the strongest economy, and I think the strongest nation in the world by far. The prediction for the number of people participating in the workforce, 61.9, came in at 62.2. And yes, you can see we're still down from that 63% that we had before the COVID crash. But we're heading back up there. We're going in the right direction. Part of the problem is there are just so many open jobs. People are quitting, and literally there is an employment shift in America that will be studied for 100 years. The gap between the very rich and the very poor is shrinking because people that were willing to work for X dollars are now saying, I'm not willing to do that because there's so many job openings. I can get a little training and get a better job. And you multiply that times millions of workers. And that's this big paradigm shift that we're seeing in America right now. Certain states, Texas, Arizona, Utah, and Idaho, You probably see the similarity there. They're red states. They're led by Republican governors. This is the kind of returns that they are seeing in payrolls. Okay, this is the number of people coming back on the payrolls, and they have exceeded or equaled, in the case of Arizona, equaled, but the rest of them have exceeded where they were before COVID hit. This is what is necessary. This is what I've been saying, not since the first month, but certainly since the 6th month of this broadcast, that we have to get back to work. We are going to lose people. This is a horrible pandemic. It doesn't matter if it came from China or what. It's just a horrible pandemic. We have to protect ourselves, but we cannot ever again shut down this country. And the leadership in these states has gotten them back in 2 years, actually less than 2 years. If you count the official start of the shutdowns, February 24th or 25th, 2 years ago. So that's a great sign right there. All right, am I missing anything? Questions? You guys are so quiet tonight. Okay, inflation. Everybody's, second biggest concern after market turmoil, right? What is inflation? I thought this would be a real good time to review this. I'm going to read it. Okay. What is inflation? Inflation reflects the broad rise of prices or the fall in the value of money. So it's one or the other. So when you go to Zimbabwe, they're not really having a broad rise of prices. They're having a fall in the value of money in their case versus the US dollar. So either of those two causes inflation. The latter of those is what people mostly get concerned about. But in fact, here in America, it's the former. The broad rise of prices is actually not as broad as it seems. We'll get to that in just a moment. But that's what inflation is. So it generally results from too much demand. People want. Okay, chasing too few goods, empty shelves, from food to car lots. Go out and try to find a selection of new cars on any dealership's lot. It's just not there. Limited service, which leads to price increase. It's just natural supply and demand. If the supply is low, then people that are selling those goods are going to have to raise their price because they don't have as many to sell. It's not that they're being greedy. Maybe some are, but they have less items to sell. And so they've got to make a bigger profit on each one to the point where the buyer says, I'm not buying. And then the prices drop and the cycle continues. Inflated prices don't necessarily hurt the economy as a whole. Only those consumers making purchases experience the increase. So if you're not consuming anything, then you probably don't care about inflation. But how many of us don't consume anything? All right. Here's a really good example of that in our local grocery store. It's come to this, folks. Anti-theft devices on steaks. I mean, you look at those prices per pound. That's not for the package. That's for the pound. All right. It's crazy right now. I understand that. All right. That's inflation. U.S. inflation hit 7% in January. I get it. It's a 40-year high. I get that too. Still, this is a spike and it will even out. And you'll see on the charts coming up that it's already starting to drop. All right. I talked about this last month, how when you look back over 1 year, the low inflation numbers we had now compared to the high ones is what makes this seem so bad. Okay. When we get to June and July, where the inflation rate was already high, the June and July from this year is not going to look so bad. So that inflation rate is going to drop because we're going against already higher numbers. Okay. So new vehicles, and I'm partly the problem here. We decided to get a new vehicle in September and we did pay over list price. This is one of the really strong areas of inflation. And part of the reason is because of the price of the item. Okay. And houses are the most expensive consumer discretionary item and cars are second. But this is a real issue and it will remain this way until the inventory gets off the boats that are out there in the Pacific Ocean and unloading at LA and Long Beach. Okay. Consumer price index changed from 1 month earlier. This was predicted to be 0.4. I didn't update this today because I just had too many other things to do, but it actually came in at 0.5. So a little bit higher, but do you see it's coming down? Okay, this is January. Go back to, December, November, October, and you'll see those bars coming down. It's happened in the past. Go back to 2018. You'll see it's high, and then eventually it comes down, and then it spikes a little bit. It comes down again. It doesn't just stay up there. You don't see anywhere on this chart where this high rate of inflation just hangs out for 2 years. And I could go back 50 years and show you this. It's just recency bias. What you're feeling at the time hurts, okay? But it's not going to stay this way. One of the reasons that we have higher inflation is because of gasoline. And I've said on this program many times, the reason that we have high gasoline prices is because our policy right now has essentially taken away from America's independence in the energy sector. It has hurt us. It's made us dependent somewhat, again, on OPEC, and that's what's driving up the cost of gasoline. Look at the price chart here when it starts happening at the end of 2020, or should I say the very first week of 2021. So this has to change. We're just paying more than we did a year and a half ago. So this shows you on a graph what this looks like. If it's again feeling like it's inflation across the board, it's just not. There's the gasoline monthly change. Look at the black dotted line. That's all items. That's the average 5.7% that we've been talking about. It's really, 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 really high on gasoline, as in 90%. Okay? Used cars and trucks, you just saw the graph on that. Energy, you're paying more to heat your home, you're paying more to cool your home for those of us here in the South. But food, okay, the steaks, I get it. But there are other food items, electricity, food away from home, in other words, restaurants, apparel, shelter. Now, this is not saying that housing prices are going up. This is just saying shelter in general, whether it's rental or used home market as opposed to a new home market. It's just limited. This inflation is limited to certain sectors of the economy. It's not broad-based. At least it's not yet. Okay? All right. Higher inflation is probably caused, this is from the Bureau of Labor Statistics here, costing you $250 a month. I know most all of you on this call, although I don't necessarily know who's going to be watching this over the next month, but pretty much all of us can deal with $250 a month. We don't like it. Okay? But we can deal with it. That's $3,000 a year. Does it mean it's going to change a little bit of our lifestyle? Maybe a little bit. For some people, $250 is a lot. I understand that. But this is not Zimbabwe. This is not 1980. This is not 1929. Okay? Let's look at it objectively. Do I want to see this come down? I want to see energy prices come down. I want to see cars back on the lots of the dealers. And I want to see energy prices in general drop. Okay? Have I missed anything here? I pause, guys, to take questions. If you have one, go ahead and ask. COVID, the topic that just won't go away. You want to see social distancing? Loan somebody some money. One of my clients, as I've told you earlier, sends me these cartoons. They're just priceless. I wish I could show you more, but I could take the whole night to do that. So the data, guys, looking strong. I mean, you got a 64% drop. Look at that meteoric drop. It's just incredible on the number of cases, even in big blue areas like New York, Los Angeles. You're seeing a drop. You're seeing those areas open back up again. I think they probably saw my slide on Florida and Texas and Idaho and Utah, right? Arizona. The deaths a little bit higher, and yet a lot of these are comorbidities. We've been talking about this. We are getting this pandemic under control. It's had a horrible effect on America in general, but it is showing signs of ebbing again. Now, we've seen this before. We'll see if this is the final ebbing or if at least it gets into a maintenance level where it's going to be with us, but we don't report on it every single week. You can see the inflation surge when COVID hit, and that's because everything changed in the supply chain. We've talked extensively in previous episodes about the supply chain in America and why this is an issue. But the consumer price index is the yellow line there. The data is not really that important. It's just you can see that we had pretty much static, 2.5%, 2.25% inflation, and then bam, COVID changed everything. So as COVID ebbs, that's yet another reason why inflation will come down, and naturally the supply chain issue as well. So I'm looking at my sheet here. Runaway inflation, it's not there. It's just not there, guys. You're hearing it in the media. It's in my notes here. It's not there, and I'm showing you the proof of why it's not. So COVID-19 pandemic led to a smaller than expected baby bust. Many people were expecting that young families would stop having children because it's, I can't afford to pay for it. I don't know what I'm going to do. Well, I'm looking at the face on this little kid. And I think he's thinking, Mommy, I don't really want this toy. I want a baby brother. So I'm wondering if it's going to have a dramatic effect on the population, and that won't be able to be discovered or analyzed for at least 3 to 5 years. But this is good news. And granted, the government assistance to families is one of the reasons why the baby bust did not happen, at least as data what we're seeing. You've seen this chart, but this is actually showing the COVID lockdown and recovery versus the Great Recession. It's the same data. This is just how quickly we came back, that V-shaped recovery from a downturn. And it's just way more powerful than what happened in 2008. And I lived through 2008. All of our clients, it was a tough time. We're way back COVID lockdown wise to where we've exceeded where we were in 2019. So that is a positive. This work from home thing, I just don't see it going away, guys. 30 to 40% of the work days over a trailing year now. This is looking back from January 31st to January 31st, 2021. We're going to be working almost 50% long after this pandemic's over. I think it's a permanent change in America. I think corporations are seeing that their employees can be just as effective, with some exceptions like on Wall Street. But I think that's part of the change that's come from this pandemic. All right. So politics, why do I do a politics section? Because politics leads to policy, which is actual law. And policy can and does have an effect on your portfolio and, of course, on your personal life as well. Okay, so geopolitical risk, that's what we're seeing. And this is on my list here: geopolitical crises, Russia, Ukraine, China, North Korea. For the most part, American investors underestimate the significance. And I think that's probably left over from post-World War II mindset where, we're the biggest, baddest country in the world. We're going to get through this no matter what Putin or Xi or Kim Jong-un are doing. The reality is that market attention to geopolitical risk is relatively low, meaning that a real serious flare-up. So if we wake up tomorrow morning and Putin's got tanks rolling into the Ukraine, it could catch investors off guard. I don't see that happening. And that's because the economic sanctions that even the Biden administration would lay on the Russian Federation would just be horrific for their people. Horrific. And I don't think Putin is foolish enough to allow that to happen. It just is almost incalculable what could happen. So specific risks that need monitoring, obviously U.S., China, Iran, Russia, positioning. There were U.S.-China issues when Trump was in office. The Iran nuclear capability went away because the treaty, Trump broke that within a month or so of being in office. And of course, there was no Russian positioning. I think Putin just took a break while Trump was in office, in my opinion. Hardly remember anything happening from January 2017 through the first part of last month, January 21, I should say. So a year ago last month. So they have a plan to help people get out. Now, this is something that's important. If you're looking for a geopolitical surprise, again, looking at my list, could this be something that roils the market? If there is as big a debacle here as there was getting Americans out of Afghanistan, then yes, this could be a problem. But there supposedly is a plan. There are 30,000 Americans in the greater Ukraine area. And there supposedly is a plan developed because, there's no way Putin's going into Ukraine while Xi is hosting the Olympics. Not going to happen. That would cause terrific acrimony between the two of them. All right. So once the Olympics are done and things wind down, could it happen? It could. We'll see. I've said earlier, I just don't think it's going to happen. This is a map. So if you live in Ukraine and you see all of these Russian armaments around you, you're not feeling real good right now. I get that. Now, of course, what Russia, and this next map is a Russian map, this is what Russia is telling their people. Oh, look at all these arms aimed against us. I like the way that the jets and the tanks are pointed east, and the Russians are pointed to the west. And we have to defend ourselves because Ukraine is coming after us. No, that's not true. That's propaganda. Okay, this is the map that's the truth. Ukraine just wants to exist in peace, and for that matter, they probably want to join NATO. That's a whole nother story. But it's important that I address these because this kind of angst, I think, is probably underestimated, certainly compared to inflation and COVID and even the political bankering. Okay, but I wanted to address it on my sheet. So economic indicators, what's in our favor is GDP. So slowing economy, this is number 3 from my list. I don't see a slowing economy, guys. GDP is strong. If you look at us throughout the world, we still have the world's biggest economy, although China is catching up. There's no doubt. So red is the Asian nations, the blue or the teal is going to be America, and the green is going to be Europe. If you want to take a shot of the screen or you want me to send it to you, it's really fascinating to see the smaller countries. You can see the major players here and what GDP they contribute to the world economy. For instance, the U.S. is 22.9, let's call it 23. Canada's $2 trillion. I mean, that's like California. They're just some really, really big players. Even Germany, only at 4. France at 3 trillion. Okay. So when we look at this and we look at it on a graph, the fourth quarter GDP, which is what's being reported now, we're obviously in the first quarter of 22, and the data coming out is reporting on the fourth quarter of 21. All right. 5.5 growth, really strong. And you can see where it looks out on the chart. We haven't had a 5.5 year like this since 1981. Obviously, with 3 down years, 2008, 2020. All right. So that's a really good GDP number. Now, the naysayers or the bears, and this is a lot of data, I'm sorry, but just look at the green here. 70% of the increase in GDP was due to companies building inventories. So what that means is of the 3 sources that create gross domestic product, the government, the consumer, and businesses, this time around, it's businesses because they are retooling. They are building up inventory. If you see the orange on the graph, that is inventories. You see it highlighted in yellow on the left-hand side there. That's what's creating the big bump here in GDP is companies rebuilding their inventory. They're doing this because they didn't have widgets to sell for so long, for months, because they couldn't get supply. So now they're saying, we're going to stock up on inventory so when the demand really takes off, we'll have it. And that, some would say, is an artificial bump. It's not really consumers. Well, you know what? Consumers are only 66%. I know, but that's 2/3. But business development is still an important component in GDP, and this has been business's time to shine. So contributions to GDP, inventories, there it is. You just saw it in the graph. There's the bar. Consumer spending, still a huge part of this. Business investment, not so much. Business pretty tepid right now as far as infrastructure building. Why? Because they don't know if they're going to need it. They might just, have their 50, 60% of their employees working from home. Okay, consumer spending on goods, not so much, mostly on services. I like the red line there, government spending actually decreasing in the fourth quarter. Here's what it looks like if you go back to 1980. Again, very strong comparing to other years. And you would expect this because we came out of negative GDP. But look at 2009. See how it was down 3% and it bumped up to 3? Well, we were down 3.5 and we bumped up to 5. This is a really strong recovery from one of the worst economic downturns in this country's history. Not only that, Wells Fargo, which is pretty good analysis. I don't know about their banking, but their research team is pretty strong. They're predicting the next 2 years will not be quite as strong, but still positive, 4% and 2.5%, which you can see on the graph, still pretty strong. Obviously, looking out 2 years, you don't know, a lot of factors that could change, but I'm encouraged to see this. Consumer spending, which you saw was the second largest thing behind the inventories, right? Exceptionally strong last year. Not quite as strong in the fourth quarter, but the first 3 quarters, you can see it's just off the charts here. It goes back to 1953. If you eyeball that over to those big lines, Yeah, we're spending money here. I mean, I'm looking at here at valuation reset, higher bond yields. You saw that, the 10-year bond is at 2% right now, a little over 2%. But the historical high for that is around 7%, or the norm, the mean, is around 5%. We're still a long way from that, And there's nothing here. Slowing economy was number 3 on my list. I'm just not seeing it. If the consumer is spending and businesses are restocking their inventory, how does that mean we're having a slowing economy? These great data pieces are happening concurrently with all the other negative stuff that you're hearing in the news, and that's what's the market environment right now. The underlying tone remains strong. Okay? Real GDP remains strong. Consumer spending, I just did this. Sorry, I went back too many slides here. A little concern. I put my concerns at the end of the section here. People are spending like crazy and not necessarily paying cash. Household debt balance rising. Home equity cards, credit cards, auto. I mean, people buying cars when they can, and they're paying up for them. That's why that orange slice is the width that it is, because they're paying more for cars than they've had to pay in my lifetime for a brand new car. Okay, because they're paying a premium. You saw that data earlier. So this trade deficit is something that concerns me as well. Again, I've given you all the good news, but I'm trying to be fair and balanced here. Sorry to borrow that from Fox News. But this trade deficit with China, eventually I would love to see more production move back to our shores so we are less dependent on China. I do not like having a deficit in our trade spending back and forth, imports, exports with China, because it makes us dependent on them. I don't want to be dependent on anyone. I would love to see this country be self-sufficient. We certainly have the wherewithal to do it. It's going to undo years of dependency. Well, I don't want to get into the political side of this, but at any rate. Okay, so the Fed. We're going to have a little lesson here on the Fed, folks. The Federal Reserve, they're a big player, okay? They're the central bank. You've heard of the European Central Bank, Bank of Canada, Bank of England, Bank of Japan. We have the Federal Reserve System. There's a Federal Reserve Board of Governors. There are 12. There's a Federal Market Open Committee. There are more than that, and most of them overlap. There are 12 regional banks. Okay, one's in Chicago, one's in Miami, Atlanta, St. Louis, Seattle, San Francisco. You get it, okay? They have 4 jobs. You heard that little quip, you've got one job. Well, they have 4 jobs, okay? Setting interest rates. They don't set all interest rates. They don't go to your local bank and say, hey, you can't charge 4.5. Now you can only do 4.25. They don't do that. They set the Fed funds rate. They call it the federal funds rate, but the rest of us call it Fed funds, okay? They maintain financial stability, and they do this by having these periodic meetings and trying to bring calm to the markets. They foster an efficient payment system, which is interesting because this is where the whole Bitcoin and cryptocurrencies comes in and why they're raising an eyebrow to that. And they promote consumer protection. That's kind of a nebulous benefit. The most important things they do are maintain financial stability and set interest rates, short-term interest rates. So the obvious question is, what happens when the Fed starts tightening? Does that mean that we're going to have a down year? Look at the data. This is the data. These are times. How does the S&P 500 perform in a Fed rate hike, Fed hike cycle? Woo, a lot of words tonight, okay? Look at the positive numbers. You see negative numbers? Yeah. 72 to 74, minus 8.6. Everything else is positive, guys. These are annualized returns after the Fed starts raising interest rates. They won't show you this on CNBC or Bloomberg because it doesn't fit their narrative, but that's the data. We can get along just fine with rate increases as long as they don't go crazy with it and jack it up to 6% within a year. They're not going to do that. It's been really low. Look at here from 2009. Okay? We had a little bit of a spike up to 2.25%. And then the minute the pandemic hit, it went back down. Okay? And so we're launching off from essentially zero rates. So is there more pain to come? Sometimes stocks can experience a correction during the early stage of a rate hike cycle. And we are, aren't we? Is it awful? No. Is it yet as bad as the last one 2 years ago? No. Is it anywhere close to what we experienced in 2008, 2009? Not even in the same relevance. Absolutely not. It's just market behavior as normal. So what's the worst reaction to a Fed minutes? Well, that just so happens to be the 5th of January. We had an almost 2% down day when Jay Powell and his cronies got up there and said, well, we're thinking we're going to have to tighten now. Well, we all knew it, Jay. It's the way you say it. And when you start making apologies saying, yeah, I probably shouldn't have used that word transitory, we're going to retire that word. Think of a different way to spin it. One of the great things Alan Greenspan did was massage words, because it's really not what they do. It's how they say it and their body language. I mean, that's what people focus in on, because it gives you a clue as to what's on their mind down the road. There are plenty of arguments that the Federal Reserve makes things worse than better. It doesn't matter. It was established in 1931, I think, and it's going to be with us. It's not going anywhere. All right. Probability of 4 rate hikes. I've said I think 3. I'm going to be wrong on that. I think we're between 4 and 5. If you look at that over the next year, all the way out to Feb 23, we're at 150 basis points, people. What did I say earlier? 6% about the mean, 5.5%, 6% about the mean on the 10-year yield. And of course, the 10-year rises when the Fed funds rises. So this is everything that drives interest rates across the board, mortgage rates, etc. If they do it craftily, carefully, subtly, the market will absorb it. You saw the data 3 slides ago. That's the truth. The market will absorb it just fine. U.S. housing market continuing the hottest January on record. It's just astounding to me. So just because people say the market's high, I shouldn't be buying now, it doesn't mean that they're not buying. All right. More than doubled in value, 6.7 trillion according to Zillow. The year ended with the housing market valued at 43.4%. In America. This is astounding. Homes in the top third represent 60%. We're one of these markets that's really benefited from that. Nashville has. Okay. And you might be in a market that has benefited from it too. So is it a bad time to buy? Well, finally, U.S. consumers are saying, yeah, it's been a really good time to buy. Now it's a really bad time to buy. Does that mean that they're not buying? It does not. It just means they're not happy about it. Okay. That's what that means. U.S. housing market has gone from oversupply to undersupply, and this is the reason they're still buying. Green shows the for rent inventory. Blue shows the for sale inventory. All right. You can see, as we're in the current year here, 2022, at the edge of the map there, the for rent inventory has gone down, and the what am I trying to say? New homes and existing home sales or inventory has also dropped. They're below what their long-term mean is, going back to 94. I'm sure if I could get the data back in the 60s, it would be near the lowest ever. And it's because people are just saying, I don't want to sell. I'm going to let this market go higher, and then I'll put it on the market. So we'll see what happens. But I think that this undersupply of houses is going to continue throughout this year. So what does that boil down to? The thrill is gone. You know the song, right? The thrill is gone, with apologies to Les Paul and B.B. King. The thrill is gone. Good time to buy, bad time to buy. Yep. But people are still buying. They realize they're overpaying. They realize they're overpaying for cars, but they want the goods, and so they keep paying up. When that stops, you're going to see an equilibrium come in. That's going to be healthy for the market, and that's going to normalize inflation. Okay? I'm going to get one more sip of water here. You guys got questions? Let me know. All right. Almost any kid would choose a toy over a baby brother. That's a good line, Doc. I love working from home too. I really do. So Granddaughter asking for a sister. Well, that's an interesting challenge for a grandmother, isn't it, Nellie? Good time to sell, but then you have to find somewhere to live. Yeah, I always tell people if you want to do really easy financial planning, just choose your death date. And if you're willing to say, this has been long enough, then sell your house, take the profits, right? Of course, then I don't know what you're going to do with it. But yeah, friends who move to motorhomes or retirement homes or move to an island somewhere. So anyway, well, that's what we've covered tonight, guys. The next CB3 Live is 4 weeks from tonight, March 10th. And as I end every broadcast, for we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. We on this program are not going to let those market pundits out there in the media scare us out of our positions. We may have some cash in our portfolios. I have not had any significant cash in the portfolios in 6 years. That could change for a short period of time, but I fully expect that when the sentiment is reset, remember those 3 big items about 40 slides ago, when the sentiment resets and people are back to blood in the streets, it can't get any worse, it can't get any worse, and everybody's selling, then there's no more sellers. And if there's no more sellers, what do we have left? We have buyers. And we need to be there for that time when the market comes back. And again, it's not like the market's in a really terrible place right now. The market's just doing what it does. And my job is to keep you informed, to keep you calm, to keep you objective. And to the best of my ability, I'm going to continue to do that as long as I'm breathing, folks. That's the goal. Thanks for being here. From Nashville, I'm Charles Brown, Portfolio Manager with CB3 Financial, where we don't just manage your assets, we become one of them. And we'll see you next month.